Hi, my name is Mike Porcelli. Welcome to the first installment of the Housing Market Crash series. This one's entitled Originate to Sell. Well, first I want to say thank you for watching the video. We're going to do a series here of videos that are going to try to shed some light on what happened with the housing market crash. The first one is the Originate to Sell, and what that basically means is, well, Originate to Sell is really how mortgage companies originate mortgages now. This is what they call it. And to discuss Originate to Sell, I think we need to first kind of go back to the way mortgages used to be before we had the Originate to Sell model. Back in the day, mortgages used to be granted by small community banks and savings and loan institutions. And what banks just simply did back then was they would take deposits, savings deposits, checking deposits from the community, and they would turn around and take that money that was deposited and they'd lend it to people in the community who needed loans for various purposes, whether they be projects or automobiles or homes. So basically it was pretty simple. If you were someone who needed a loan, you would go to the bank and you would sit down with the banker. And when it was a community bank, the community knew each other. So sometimes you even knew the banker, and it was a face-to-face thing. And you kind of look the banker in the eye, and he'd look you in the eye, and most of the times, I guess the banker would know your family. Maybe they would know your business, and they would make the loan based on more than just a credit report. They would say, well, I'm gonna. I already know how much you make. Your savings is in our bank. I know you have to make a large down payment because we just don't lend you all the money. We need to show us that you have the ability to save. And of course, I know you're still working there, but I'm going to call and make sure everything is okay with your job. And they're gonna ask some questions, and at the end of the day, the bank is going to make the loan based on the idea that the loan is going to perform. And when the borrower signs that note becomes an asset of the bank and of the savings and loan, and it is a part of their balance sheet. And we say today, if a bank does that, it's a portfolio loan, but that is very few and far between. But in the old days, that's the way that it worked. So it was really kind of like a closed-loop system where the money would come from the community, it would go into the bank would pay the depositors some interest, and then they would turn around and they would lend the money out to other people in the community who needed it, and they would pay interest on the loan. And the bank would earn their keep by just keeping the difference between how much they would pay interest to those depositors and how much they would collect in interest from those people who borrowed. A pretty simple system. Well, that's kind of changed. that portfolio, if you will, model has been replaced by what we call the Originate to Sell model. And it's important and notable because some of the idea is great, and once I explain it to you, I think you're going to understand, and it's just kind of good for a bank to do it this way, and it's enormously profitable, which banks like. But there are some things, that fundamental problems that they have yet to iron out. So let's talk about that. First, let's talk about what Originate to Sell means. All right, so we'll do a little comparison and contrasting. All right, with the Originate to Sell model, the bank is still writing mortgages. However, they're not taking depositors' money and lending it out to borrowers. They open up a line of credit for some of these banks, many hundreds of millions of dollars, and they open up a line of credit for the sole purpose of lending that money out on mortgage loans only. Okay. Then they create a mortgage department, and they take mortgage applications from people who want to borrow money to buy homes. They underwrite the loan just as if they were lending out deposits, They make sure there's income and assets, and they check their credit reports and that whole deal. And they agree to write the loan. And they give the money to the borrower, and the borrower signs a note that says, I promise to pay the principal plus some interest. Okay? Now, that's the same as you would have with a community bank, save for the difference of where the money comes from. With the Originate to Sell, it comes from a credit line. From the community bank, it comes from depositors. Well, once they have that note, this is where the big change is. With a community system, that note becomes an asset of the community bank, and they leave it there on the books. Okay. Well, with the Originate to Sell model, what happens is now they take this note and they sell it to what's called the secondary market. Now, a secondary market purchaser of that note is going to give the community bank the money for the sale of the note. So let's use some numbers. Let's say the borrower borrows $100,000, takes a $100,000 mortgage. So the bank will take $100,000 off their credit line, lend it to the borrower, charge the borrower some fees, underwriting, origination, processing, right? And they'll take that loan and say it's $100,000 at a certain rate of interest and sell that loan to the secondary market and get money back from the secondary market. Now, the higher their interest rate on that loan is, the more money they get back. They may get back 3 points or 4 points on that loan. So let's break it down. They borrow 100 from the credit line. They lend it to the borrower. They charge the borrower origination fees, processing fees, underwriting fees. The borrower signs a note, and the bank sells it to the secondary market, and they get a profit back on the sale of the note, maybe $105,000. And so then now they have $105,000 plus their fees. They pay the interest on the credit line. They pay back the credit line, and now they just have a nice tidy profit. Now, if that loan goes bad, it's not on their books, so they don't lose any money. And, you know, that's a problem, I think, because what happens today is the loan officer who writes that loan and approves that loan, he is not necessarily concerned about anything more than his ability to take that note and sell it for a profit. So no longer is it important to him whether or not the borrower qualifies and whether or not that loan's going to perform, but more important is, can I sell that loan? Can I get paid on that loan? So think about this. Now, and we're going to get into this with the next in future installments of this series. But what happens is now the loan officer is no longer interested in protecting the money. He's more interested in selling this note. So if the buyer of the note doesn't care that there's no verification of income, then the loan officer no longer cares if there's no verification of income or verification of assets, or even whether or not the borrower has good credit or any ability to repay the loan. Now, in the old days, in a community bank system, let's contrast, if the borrower, if the loan officer made a bad loan and the borrower didn't pay, the loan officer has to explain to the bank president and the whole community why he made the loan to that guy down the street who had no business getting a loan in the first place. So I think, and I wanted to open again with this first because I feel it's important that everybody understand that we did have some responsibility in this whole housing crisis. We originators, you know, we should have known better, but we weren't alone. So anyway, stay tuned for the next installment. My name is Mike Porcelli, and all my contact information is right there. So if you want to talk more about this with me personally, I have a big passion for this, so I look forward to seeing you down the street. Thank you very much. Have a great day.